The Federal Reserve has just thrown down the gauntlet against President Trump, and the stakes couldn't be higher for your wallet. Today, we're diving into what might be the most consequential economic standoff of 2025. In a unanimous decision that's sending ripples through financial markets, the Federal Reserve has kept interest rates unchanged at 4.25 to 4.5%. What makes this particularly interesting? They're holding firm despite direct pressure from President Trump to cut rates. But there's something even more unusual in their announcement that has economists worried about what's coming next. For the first time in recent memory, the Fed is warning about rising risks of both higher unemployment and higher inflation simultaneously. This rarely happens, and it signals we may be heading into economic territory we haven't navigated before. So why is the Fed standing pat when the White House wants cuts? And what does this mean for your finances in the coming months? Let's break it down. The Fed's decision comes against a backdrop of what they're calling solid economic expansion. Just last week, the Labor Department reported 177,000 new jobs added to the economy, continuing a year-long growth trend. On the surface, things look stable, but dig deeper and you'll find storm clouds gathering. Fed Chairman Jerome Powell didn't mince words, stating that uncertainty about the economic outlook has increased further. This uncertainty stems largely from President Trump's recent sweeping tariff policy, implemented on what his administration called Liberation Day. These new import taxes have injected tremendous unpredictability into not just the American economy, but global markets as well. The timing here is critical. The Labor Department's job report showing healthy growth was compiled before these tariffs were announced. In contrast, the more immediate ADP jobs report, released after the tariff announcement, showed job growth plummeting to just 62,000. That's a dramatic drop that suggests businesses may already be pulling back on hiring due to economic uncertainty. What makes the current situation particularly challenging is the unusual economic dilemma we're facing. Typically, the Fed worries about either inflation or unemployment, rarely both simultaneously. But Trump's sweeping tariffs create exactly this paradox. They could drive up inflation by making imported goods more expensive, while simultaneously causing unemployment to rise as businesses face higher costs and potentially cut jobs. Brian Jacobson, chief economist at Annex Wealth Management, put it bluntly. The Fed statement was a statement of the obvious. They gave roughly equal airtime to the threats to growth and inflation. In other words, the Fed is in wait-and-see mode, trying to determine whether controlling inflation or preventing job losses should be their priority. For consumers, this creates a potentially painful scenario. You might soon be paying more for everyday goods due to tariff-driven inflation, while job security becomes less certain across various sectors. Industries that rely heavily on imported components or materials are particularly vulnerable. Powell's press conference after the decision offered some insight into the Fed's thinking. For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance, he explained. He described the economy as still healthy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses. Reading between the lines, the Fed is clearly concerned but not yet panicking. Despite the Fed's current stance, many economists and Wall Street investors still anticipate 2 or 3 rate cuts before year's end. The question is whether these potential cuts will come soon enough to prevent economic damage from the tariffs, or if they'll instead be reactive measures after problems have already emerged. What's particularly noteworthy about this economic moment is how front-running behavior has already impacted the economy. The Fed specifically mentioned a drop in first-quarter output due to record imports as businesses and households rushed to front-run new import taxes. In simple terms, companies and consumers stockpiled imported goods before tariffs took effect, creating artificial demand that will likely be followed by a corresponding drop. For investors, this uncertainty creates both challenges and opportunities. Bond markets are currently pricing in future rate cuts, while equity markets remain volatile as they attempt to price in the competing forces of tariffs, potential rate cuts, and shifting consumer behavior. Looking ahead, the Fed's June meeting will be crucial. By then, we'll have more data on how the tariffs are affecting both inflation and employment, giving the Fed clear direction on whether to prioritize fighting inflation or supporting job growth. So, what should you be watching for in the coming weeks? Keep an eye on inflation indicators, particularly in categories heavily affected by imports. Watch employment numbers, especially in manufacturing and retail sectors. And perhaps most importantly, pay attention to consumer sentiment and spending patterns, as these will ultimately determine whether we're heading for a soft landing or something more turbulent. The Fed remains strongly committed to supporting maximum employment and returning inflation to its 2% objective. But achieving both goals simultaneously has just become considerably more challenging. What do you think about the Fed's decision to hold rates steady despite presidential pressure? And how are you preparing for potential economic changes in the months ahead? The Federal Reserve's next policy meeting is scheduled for mid-June, when they'll have more data to assess the real economic impact of the new tariff regime. Until then, we're all navigating in somewhat uncharted waters,